Okay, so welcome everyone. We stopped after the first chapter last week, and now we want to move to the explanation of the existence and functions of banks. I want to show you in this chapter one of the probably most famous models we have in financial economics, that is the diamond model. Diamond as in Douglas Diamond from the University of Chicago. There are actually two very famous models in theoretical banking and financial economics. First, that's the diamond model. We'll see this today. There is an extension that is called the Diamond and Dybvig model that is related to bank runs, but we'll see here one possible explanation, one theoretical explanation for the existence of banks. And we'll start with financial contracts, and we'll ask ourselves, why do banks exist? Because in a perfect market, that is, in a market without transaction costs, without taxes, without any so-called frictions, any imperfections to the market, we would have depositors, aka investors. If you are a depositor, you are also investing in a bank, as in giving a loan to the bank. Investors could simply channel their savings efficiently to investment projects without the need to include a bank. Why? Because what is the bank doing? It only takes in deposits from depositors, and it gives out deposits again in the form of loans to other clients. Now, if we have no transaction costs, no market frictions, and perfect information with all market participants, why should we need a bank? You should simply select the investment project and directly invest into this investment project into which you want to invest. So in a perfect market, banks would not exist. Of course, then we could argue that markets are not perfect. We have market imperfections, and therefore it might be reasonable to assume that banks should exist. The question now is, which market imperfections lead us to the situation in which banks exist, and banks lead to an improvement over the situation in a market without banks. And this is why theoretically we need to look at this idea that we need to explain why banks exist. So first of all, transaction costs exist. For example, costs of financial contracts. We need, for example, a lawyer to draw up a financial contract. We need to monitor projects, and so on. So we have transaction costs. This is the neoclassical approach, simply to argue because of transaction costs, banks are somehow able to reduce transaction costs, and therefore it makes sense to have a financial intermediary. Second, banks provide certain services that no one else provides. This is a very lazy explanation, actually, because you could think of other financial intermediaries or other market participants to provide us with these services. And third of all, we have an information economics approach. That is, information is not equally distributed among market participants. And for some reason, banks are able to provide market participants with a better situation in which they have more information on project outcomes and the reliability of, for example, a partner in a financial contract to repay a loan and to fulfill one's contractual obligations. So we'll start with asymmetric information. First of all, is everyone aware of what asymmetric information means and what it implies? It's a situation which we encounter many times, a situation where you have two contract partners and one of the partners is better informed than the other one. For example, if I wanted to sell you my notebook, I know whether it works, whether it functions, and you cannot look inside. You do not know how old it is. You are relying on some sort of information that I need to provide you to assess the value of the notebook. Same thing with, for example, if I gave you something that looks shiny, you don't know whether it's gold or not. You need to invest more costs, and you have additional costs to reduce the asymmetric information between us. So asymmetric information is present when one party of a transaction or a contract possesses more information than the other party. If the better informed party can take advantage of this lead in information, it may lead to various difficulties in negotiations or even prevent a transaction contract in the first place. There are some famous examples where markets can even break down due to asymmetric information. Do you have any example where you would not trade and you would not enter a contract without additional information? For example, you wouldn't hire a person without a CV, without some additional information on the education and the skills of that person. No? But by asking for a CV, by asking for some additional information, or by performing a job interview, you have additional costs. So you have search costs, you have friction costs, and you need to invest more money to reduce the asymmetric information between the two contract partners. So eliminating problems associated with asymmetric information causes costs for project evaluation, monitoring, etc. These are equal to the difference between the so-called best solution at symmetric information. This is always the first best solution. The situation in which both parties have perfect information, that is the situation in which we would have no information costs. And this is always the first best solution, the situation we would like to have. And asymmetric information, that's the second best solution. And the difference are made up by the search costs and the costs associated with reducing asymmetric information. And asymmetric information and financial contracts now play a central role in bank theory or banking theory. By the way, this is also a large part in Professor Vollmer's financial intermediation class. This is a part where business actually intersects with financial economics, and some of our colleagues from the economics section, they also deal with this type of theory. Now, service and compensation in a financial contract do not take place at the same time, and in many cases where you have a difference, a time difference between service and compensation in a contract, you have this situation of asymmetric information. So the design of a financial contract depends on the certainty of compensation, the information distribution among the two partners, and the risk tolerance of lenders. Now, under certainty and symmetric information, the interest conditions can be calculated with the internal rate of return. In a perfect market where everyone knows what amount of capital is being repaid, and you know the probabilities, and you have symmetric information, you simply calculate the internal rate of return and you would have no risk premium. Under uncertainty and symmetric information, you need to include the individual risk tolerance, that is the information whether you as an investor are risk neutral or risk averse or risk loving, and you need to include this to formulate a financial contract, that is, you need to include a risk premium. And in the case of asymmetric information, you need special measures such as so-called incentive compatible financial contracts, monitoring, because verification of project returns is not possible. What does it mean? In the case of symmetric information and uncertainty, you do not know exactly what the project will pay out, but each and every contract partner can monitor the outcomes. So there's no possibility of one contract partner defrauding the other party. You cannot simply run away with the money. But in this third case, in the case of asymmetric information, you might invest into a project and your partner tells you, oh, sorry, I lost all your money. But in reality, he did earn a large profit. And you need to invest more money for monitoring, or you need to come up with a so-called incentive-compatible contract. And the question now is, what does it mean? Incentive-compatible contracts. What could that be? Think of a situation in which you would invest, for example, into the company, the startup company of a fellow student. A fellow student asks you for 10,000 euros and you are asked to invest into this project. Now, what could happen? This company, the startup company, simply runs away with the money and you lose 10,000 euros. Now, what would an incentive-compatible contract be? Because obviously, the other party has an incentive to run away.
So you need like a contract when you give an incentive to the other party to don't run away with the money?
Yeah. An incentive-compatible contract is a contract that forces all parties to stick to the contract because it is aligned with their own incentives. So the incentive of both parties is now to stick to the contractual obligations and not to exploit the asymmetric information. In some cases, this could be that, for example, the other party has an incentive to disclose information. This is the case many times in insurance. Insurance companies give their customers an incentive to disclose certain information. Why? How do they do this? If you think, for example, of an health insurance. Yeah?
In some cases, it invalidates the contract.
Yeah, exactly. You will have clauses in your contract that your contract will become invalid in case you haven't disclosed all pre-existing conditions, for example. No? And this is a matter of designing the contract. Now remember that we are talking about financial contracts, that is a security, a stock, a loan, a bond, whatever. If you are uncomfortable with this term financial contract, simply think of a bond or a loan. An investor gives out a loan to a company, the company invests the money into a project, it has a profit or a loss and it repays the loan. But we want to make it as general as possible, so that is why we are talking about financial contracts, because a loan, a bond, a stock is nothing but a financial contract. Okay. Financial contracts, we need, in a situation with asymmetric information, we need incentive-compatible contracts. Okay, now let's turn to the different explanatory approaches to explain the very existence of banks. Now, let's start with the neoclassical explanation. Transaction costs. A risk-averse lender can increase his or her utility by increasing the number of projects he or she is investing in. However, it might be too costly to invest in a large number of projects because each financial contract is associated with costs. So, remember why transaction costs could explain the existence of a bank. Let's assume that we have monitoring costs, that we have costs associated with contracts. So instead of simply taking our money to 20 projects, we want to invest it into one project that is already diversified. So the bank is just a tool to accomplish diversification at lower costs. Now we have a financial intermediary, could be a bank, could be an insurance company, and the financial intermediary can lower those transaction costs by decreasing the number of transactions, lowering the cost of each transaction through standardization, and profiting from economics of scale. That is, if financial contracts have fixed costs, transaction costs increase less than proportionally to the financing volume. In other words, the financial intermediary, the bank, is simply a nice, convenient way of pooling capital and reducing transaction costs, because it can now use more capital to invest in a diversified portfolio. Not to decrease asymmetric information. So financial intermediaries can lower transaction costs without reducing diversification. So it's easier to invest for us as an investor to invest into one bank than to invest into, say, 10 or 20 investment projects. Next explanation, financial intermediary as service providers. For example, one could think of credit rating and assessment and project evaluation and monitoring. Also security trading, brokerage, financial trading, financial auctioning, and so on. And they can also offer long-term loans and accept risk-free short-term deposits. Again, this is not a very compelling argument because investors could also do this on their own if they just specialize. And next, the information economics explanation. We have asymmetric information, and this could discourage parties from entering a financial contract. If you cannot assure me that you would run away with my money, I would simply not enter that contract. If I have no reassurance that you are forced to repay your loan, I will not give you a loan. Quite simple. So the market could break down and we would not have any financial contracts. So it seems that it might be that financial intermediaries can reduce or eliminate the information asymmetry by evaluating and monitoring projects and formulating incentive-compatible contracts. For example, we have N entrepreneurs, companies, and capital providers, L, like in lenders. And we have information asymmetries between the companies and the banks. So the information asymmetry could be regarding to and related to the probability and the amount of returns. So I do not know whether the company will repay me 10,000 with 100% probability, or it will repay me 8,000 euros with 80% probability or 20% probability, and so on. And the costs of reducing those information asymmetries might be prohibitively high for each individual lender. So what could financial intermediaries, what could banks do? They gather information and they provide information to all lenders. In other words, a bank is nothing but a big risk manager and rating agency that gathers information and provides rating scales and ratings for companies, and it monitors business projects. So a bank, the existence of a bank could be beneficial for every party. First of all, the financial intermediary can, because it now gathers information on companies and sells this information to a larger number of entrepreneurs. It can amortize the costs of acquiring the information by selling it repeatedly. Each lender reduces the monitoring costs because it can now simply buy the information from a bank, and it does not need to monitor and gather the information for each entrepreneur on its own. And the entrepreneur, the companies, are able to acquire the necessary funds because now lenders are willing to enter financial contracts. This is one way of explaining the existence of a bank, that a bank is simply sort of a trading place for information. It gathers information on possible investment projects. It sells this information to lenders, and it enables entrepreneurs to get funds. However, the problem is with this approach that the information provision of the financial intermediary still does not eliminate the asymmetric information problems between the entrepreneurs and the lenders. The problem now is that in this case, the asymmetric information now suddenly switches to the contract between the lenders and the bank. Why? The financial intermediary would be better off if the bank would simply save the monitoring costs and it will simply made up information on the lenders. On the entrepreneurs. So the bank could save the money, it could cooperate with the companies, it could provide false information and share the returns equally between the companies and the bank. So explaining the existence of a bank coming from information economics doesn't really work, because it simply switches the asymmetric information problem from the contract between the lenders and the entrepreneurs to the case of the lenders and the bank, because now the banks could cooperate with the entrepreneurs. This might seem strange to you. You would immediately think, but this is very unrealistic. We have legal rules in place, we have laws in place that prevent this from happening. Yes, but this is a situation where we haven't come up with these rules, and we haven't come up with laws, and we haven't included these clauses into our contract, and this is how we are going to explain the existence of banks. So this is a case or a world in which we have asymmetric information, but we haven't put up those rules and those clauses in place that prevent this type of behavior. So the lender can neither rely on information provided by the bank or the entrepreneurs. Both will lie, because they are both better off. And the monitoring activity is not sufficient to explain the existence of a bank, because the problems associated with information asymmetry still persist. Okay, so we need another model, and this is the diamond model. It dates back to, I think, 83. Again, this is, I guess, one of the most fundamental models we have in banking, because it explains quite nicely, and it's quite simple, the existence of banks. It has been extended in numerous ways. It's the foundation for the Diamond and Dybvig model of bank runs. And I want to show it to you because this is, I think, necessary. It makes sense to have at least one theoretical part in such a lecture on banking, even if this is not a financial intermediation class. Let's start with the basic notation of the model. We have N risk-neutral entrepreneurs. The entrepreneurs, companies, they are noted with N, with a capital N. And each company has an investment opportunity. They don't need 3 or 5 investment opportunities. Each company has one project it wants to invest into. The project has financing costs of 1. And this is something we often do in these models. We standardize, we normalize certain payments to 1, because then 1 plus R is the payout after one period, and you know that, for example, here R is the return. So if we invest 1 monetary unit and we get 1.10 out of it, we know the return on this project is 10%. Quite simple. Now, the stochastic return of the investment project with an investment of 1 monetary unit, could be $1, is Y with a tilde over it. It can be between 0 and infinity. So we might get out a return of 10,000 or 100, or we could lose all our money. We have invested $1 and we could get out $2, $5, $10,000, would be very unrealistic, but we could also lose our dollar investment. Now, Y tilde is stochastic. The expectation, the mean, the expected mean of Y tilde is larger than R plus K. R is the risk-free interest rate. And again, remember R, we have an investment of $1. R minus 1 means that we are subtracting from R the $1 investment, and R minus 1 is the risk-free interest rate. R is the return on the risk-free investment, but that could be, for example, 1.1, 1.05, so it's a monetary unit, not a percentage. Yeah?
Would the value of the risk-free interest rate change if we were using more than 1 monetary unit?
No.
Okay, so the
No.
R, the 1 and R minus 1 always stays.
Yeah, R minus 1 already implies that R is the total return on a $1 investment in the risk-free asset. Yeah. Okay, then K are the monitoring costs. So we have additional costs later on that we need to have in order to monitor the outcomes of this project, and the expected return on the project should be larger than R plus K. Again, remember, Y tilde is stochastic, so the actual return could be higher or lower. It could be that it pays out 0. It could be that it pays out much more than R plus K, but in expectation, we are expecting the average return to be larger than R plus K. Y without a tilde is the actual realization. That's the actual return on the project we can observe afterwards. But ex ante, we do not know what the project will pay out. We have M, risk-neutral lenders. Each one has a fund of 1 over M, meaning that we need all lenders to finance this one project. So M lenders all together will finance one monetary unit, one project. Z as a function of Y, larger or equal than 0, is the aggregate payment from the entrepreneurs to the lenders, meaning that you have to distinguish between the actual payout of the project, which is Y, and Z of Y, the companies pay back to the bank. This is the case in which the companies actually earn a profit, but they do not pay back their loans. That is still a possibility. Without an incentive-compatible contract or without any laws that force the bank to pay back the loan, it could be that we have a profit here that is even larger than the risk-free rate, but Z of Y is just 0 because the company defaults on its loan. That is still a possibility. And Y minus Z of Y then is the income of the entrepreneurs. Why? It earns the actual realization of the project, let's say $10. It has to pay back Z of Y. It has to pay back the loan with interest. And the remainder, the residual, is the income of the company. So after having paid back the loan, the rest remains with the companies. And K are the monitoring costs, and we'll also have delegation costs that we haven't seen yet, but we'll see this later on. Is that clear? More or less, yeah? $1 investment into a project, and risk-neutral entrepreneurs, a stochastic return on the project. We have an expected return on the project that for the company, first of all, that is higher than the risk-free rate plus the monitoring costs. And the company can then decide on how much it repays on its loan. It can repay at 0. It can repay the loan with interest. And the residual is paid back to the company, stays with the company, and we have monitoring costs and delegation costs. Okay, we have one entrepreneur with an investment project with uncertain outcome Y tilde, investment of one monetary unit, $1. The company has no liquid funds, so it needs to finance this with the lenders. It needs to raise capital from multiple lenders. Only the company can observe the outcome of the investment project. Actually quite realistic. The company, let's make it more realistic, let's make it more intuitive. We have a company that wants to invest in a new, we have a fintech. Oh no, let's not make it, let's take my favorite example in my first semester class. We want to open a pizza place. We have a company that wants to open a pizza place. It needs $1. Okay. Only the company can assess the success of our pizza place, of our pizza restaurant. The financiers, the people, the bank, the investors who financed our $1, they don't want to come to the pizza place and see how is the company doing, how is the pizza restaurant doing. Only N can observe the outcome of the investment project without costs. The investor would need to drive to the pizza restaurant each and every day to have a good assessment of the success or failure of our company. And those are, first of all, the costs. So without monitoring, N would always report investment outcome 0. If you don't go to your pizza restaurant, you're financed, the owner would simply tell you, sorry, I haven't sold any pizzas. Y would be equal to 0, and we would simply tell our investors, sorry, we're broke. Y would be 0, and the company would maximize its profits. A financial intermediary can now monitor the project's outcome for monitoring costs K. That is, the bank now requests income statements, it can drive to the pizza restaurant, it has monitoring costs of capital K. Additionally, the financial intermediary can create an incentive-compatible contract, for example, with non-pecuniary penalties such as loss of reputation and search costs for a fired manager. This is now important. The model works with non-pecuniary, non-monetary costs. Why is that? If you were to impose pecuniary costs, someone would have to pay, and it might be that the other side now has an incentive to force the other side to pay a penalty. So we need a penalty. The company has to pay, but the other side doesn't profit from. Is that clear? Now, again, you have information asymmetry that the company has an advantage over the investor. And the solution cannot be to force the company to pay more money to the investor, because then the investor would again have an incentive to force on those penalties. So we need non-pecuniary penalties that only punish one side that has more information, and that is the company. What could these non-pecuniary penalties be? In German, nicht monetäre, keine Geldstrafen. What could these non-pecuniary costs be? It could be, for example, that the manager running the company has a loss of reputation. And if the pizza restaurant goes bankrupt, if it doesn't pay up, for example, this manager of this pizza restaurant, of this company, doesn't get a new job afterwards. This loss of reputation is a cost to the manager, but it is not an advantage to the investor. I don't profit from the fact that I know that the manager of my previous investment now will not get a job. Yeah, this might give me some satisfaction, but I do not profit from it monetarily. Now N and the financial intermediary get an incentive for disclosure. So this is the case where you have non-pecuniary costs to the company and its managers in case they default. Yeah, they need to go to a lawyer, they need to go to the courts, to the bankruptcy courts, they need to file for bankruptcy, they will not get a new job, and so on. And these non-pecuniary costs force the company to voluntarily disclose more information on the profits and the outcome of this project. So all lenders have an alternative investment opportunity with the risk-free interest rate R-1. So we have a risk-free asset, and we need to offer the investors an incentive-compatible contract so that they will invest in our company's investment and our company's project and not in the risk-free asset, because this would then be a better alternative. Now, N has to offer a contract with a repayment of Z of Y larger or equal than R plus K. Both sides divided by M, because remember, we need M lenders, and we don't have one investor, we have M lenders, and each lender doesn't invest the full amount of $1, but only 1 over M dollars. So again, this is the same here as we have seen here with the payment has to be larger than R plus K. So the company needs to offer you a contract stating that repayment, and not the expected repayment, but actual repayment, is larger or equal than the risk-free rate plus the monitoring costs. If not, monitoring costs are prohibitively high, and the lender would see that, well, actually, I do not need to invest into this because I can see that the risk-free asset is giving me a higher return. So the Z of Y over M has to be larger or equal than R plus K for every lender. And of course, the repayment has to be larger than R plus K for all lenders in sum. The company raises capital of 1 over M from all lenders, and we have lending in T equal to 0 and an actual income of Y after one period. And of course, if we have no monitoring, K is equal to 0, and under symmetric information, N could promise L Z of Y over M as repayment if the expected return is larger than R, and it can simply keep the expected return minus the actual repayment. And in this case, because we have risk neutrality, the actual distribution rule for the earnings is irrelevant. Remember that risk neutrality means that you are indifferent between a safe and deterministic payment of, say, 10 euros and an expected payment of 10 euros. In other words, risk neutrality implies that you are looking for, that you are basing your decisions on the expected return. So what does this mean? Under symmetric information, we do not need monitoring. If we do not need monitoring costs will be 0. So K is 0. And then you can immediately see that the repayment has to be larger than R. And N could simply promise this payment if you have a higher return, expected return, than R. In this case, you can simply promise the repayment because you know that you are making more money in expectation than the risk-free asset. This is the general setup. This is still a German slide. I think we'll have it translated by the end of the semester. But this is also explained in the Hartmann-Wendel's Pfingsten-Weber textbook, although I have to say I would advise you to have a look at the original research paper by Diamond, because I think the explanation in the original paper is much better than in this textbook, because it has been translated. The way it is shown in the textbook is slightly different, and it is harder to follow the notation in the textbook. You know?
You said the risk neutrality says he only looks for the outcome of the project.
No, he or she only looks and bases all decisions based on the expected value of the relevant variable. Now, if you, for example, Risk neutrality is defined by the indifference between a safe, how should I put it? It is usually defined with so-called lotteries. Imagine two situations. First of all, you have a safe payment of 10 euros and a second situation in which you can you have two stochastic payments, say 5 euros and 15 euros, each with 50% probability. Now, if you are given these two choices, 10 euros safe or 5 or 15 euros with 50% probability, and if you are indifferent between the two, you're risk neutral. If you opt for the safe payment, although in expectations both alternatives are the same, if you opt for the safe payment of 10 euros, you're risk averse. If you take the lottery, 50-50, 15 and 5 euros, you're risk loving. And this is how you can define the risk aversion of an investor. And here, because we are assuming risk neutral entrepreneurs, it means that they only look at the expected return. And if the expected return is higher or lower than, for example, the risk-free rate, they will, for example, do the investment or they will take the risk-free asset. But in this case here, if the repayment, the expected return is higher and larger than R, then you will invest in the project.
So there is no 50-50 situation. If you take the same example, we have like 17% for 15 euro and 30 for 5 or 10 euro safe. The risk neutral person would go for the 70% because it's a high expense.
No. Those two alternatives are completely separate. And if you are indifferent, it means that both alternatives have the same expected value. If you change the probabilities in my example, 5-15 to 30-70%, then the other alternative, the stochastic alternative, under risk, has a different expected value. And then you cannot decide which you would choose. And then the risk neutral person would probably go for the alternative with the higher expected value. And this is risk aversion. Okay. So with the entrepreneurs, we have the investment of 1, we have an outcome of Y, we have a repayment of Z of Y, and we have M lenders that give us the $1 in total. Okay. It's exemplified with a numerical example. The investment project requires $1. It has a stochastic return of 1.5 or 0.8. The 0.8 return is obviously the case in which the investment operates with a loss. So the company will lose money and it will not be able to repay the $1 loan. 60 and 40% probability respectively. Each lender has $0.1 to give and to invest. We need 10 investors to finance this project. The risk-free rate is 10%, so R minus 1 is 10%. And L will invest only if the expected repayment is 0.11 monetary units, that is $0.1 times R. And the expected project return is quite simply 1.5 times 60% plus 0.8 times 40%. So the expected project return is 1.22. But then we already know how large the monitoring costs can be. Under symmetric information, every lender will finance the project if the expected repayment is larger or equal than $0.11. For example, repayments could be, in case we have an outcome of 1.5, so the project is profitable, it can pay out $0.13. In case we have a loss, it will only pay out 0.08 in case of success and failure. Expected aggregate repayment to all then is 1.3 times 60% plus 0.8 times 40% probability. That is 1.1, and that is equal to the risk-free rate again. So the project surplus of the company is the expected return, that is $1.22, minus the repayment in both scenarios, and this is 1.1. So this is the aggregate repayment in both scenarios. And this difference here, this 0.12, this is the project surplus. This is the profit that goes to the company. Now remember, the situation of symmetric information is the first best solution. This is the best case scenario we can get, and we need to compare every other contract we might come up with the first best solution, and the difference between the first best and the second best solution is the total amount of monitoring costs, of transaction costs we can afford. Now let's look at a case of a contract with a direct financial relationship. A financial intermediary can now be beneficial let's go one step back. How would we now prove that the existence of a bank is beneficial? We need to compare the cases of first best, symmetric information, situation with no financial intermediary, and if we can see that we can improve on the case of asymmetric information without financial intermediation, we can see that including a bank reduces information costs and transaction costs and delegation costs. And this is how we can prove, yes, theoretically, this existence of banks makes sense. So we've seen the first best solution. Now let's turn to the case of a direct financial relationship between the lenders and the entrepreneurs. Now we can include a financial intermediary if and only if it decreases the cost associated with this cooperation problem between the lenders and the companies. The benchmark is the direct relationship between N and L, company and lenders. N has to offer every L a contract that restricts his own scope of actions, because every L can always invest in the risk-free investment. So, first, the company has an incentive to inform about the project progression truthfully, or second, the lender is allowed to observe the project progression. Both cases will lead to the same result. In the case of our pizza example, either the pizza company, the pizza restaurant, wires us information on the amount and the number of pizzas sold, or we get an incentive to monitor it by ourselves. No? Yeah?
I didn't really understand the third point, and has to offer a contract that restricts his own scope of action.
N, well, first of all, in asymmetric information, without any clause or without any contract that is incentive compatible, no lender will enter such a contract. Because we know, the lenders will know that the company has an incentive to completely defraud the investors and to default totally on its loan. So the company, in order to get capital, in order to get funds, needs on its own to offer a contract which has a clause which includes some restrictions, so that the lenders know, okay, I as a company will not default on my loan. But this restricts my actions, because I am no longer able to default or to disclose information untruthfully. So in comparison with a case where everything is possible, this is restriction on the possible actions of the companies. Yeah? Okay. Now we need non-monetary, non-pecuniary punishments. This could be imprisonment if you commit bankruptcy fraud, poor reputation, loss of manpower, no additional job afterwards, and those punishments without they need to be non-monetary, without transfer of assets, so that they hurt the company but they don't benefit the lenders. Otherwise the lenders would now have an incentive to cause and to push the companies into default, and this is not a very good solution. So we need to give the company ex ante an incentive to meet the repayment terms punctually and truthfully. Why do we need this? If N doesn't meet the repayment terms, he or she doesn't have any assets which could be liquidated by N. This is also a reason why we need non-pecuniary punishments. First of all, the lender should not profit from it, and second, how should the company pay a pecuniary punishment if it's already bankrupt? This is why we, for example, have jail terms for bankruptcy fraud. If you punish someone who has just gone bankrupt, there is no money to punish him with. So you need additional non-monetary punishments. This is also an example where I think the original description in the Diamond paper is much better than in most textbooks. Okay, so we try to come up with an optimal contract with an additional penalty function that is incentive compatible and optimal. In this model, the non-monetary penalty for N depends only on the repayment amount Z of Y, because it's the only observable variable for both lenders and companies. Remember, the company does the investment project, but the investor can only observe what is actually being repaid. I cannot, without monitoring, without additional cost, I cannot see what the actual payment to the company from the project was. I can only observe what the company is repaying on its loan. So Z of Y is the only observable variable. Then we need a penalty function phi of Z of Y. Actual return, actual repayment, and the penalty that depends on the repayment on the loan. How does the optimal penalty function look like? It should provide incentives for N to meet the agreed terms of repayment. This is quite natural. The penalty function, any penalty, needs to give an incentive to stick to the rules. And this is what we want with the penalty function to do. The optimal contract now is, and I'm not showing you how this is derived, I'm simply giving you the result, but you can have a look at the original paper. Phi star of Z of Y is the maximum of H minus Z of Y or 0. Quite naturally, if the company repays the loan fully, there will be no penalty. So the penalty will be 0. But you don't get a gift, and you don't get a benefit if you just stick to your contract and repay your loan. So the best case solution, the best case scenario is 0 penalty. But H minus Z of Y is also a penalty, and H is the agreed repayment. And it is the smallest amount N has to pay to L to not receive any non-monetary punishment. Meaning that if you have a $1 loan and you repay 99 cents, you will get a lower penalty than if you only repay 10 cents. Now, so punishment will increase by the amount you're defaulting on your loan. And this contractual form is considered a normal debt contract. This is a debt contract. Why is it optimal? First of all, this is the optimal contract. H is the agreed repayment. And this contract here, so that is a financial contract that includes this type of penalty function, is optimal and incentive compatible. First of all, what does incentive compatible mean? It means that both parties have an incentive to stick to this contract. And optimal, what is optimal? It reduces transaction costs. Because we could think of different contracts in which one party is unduly punished, but we want this contract to have the lowest possible penalty so that both parties still stick to the contract. So an optimal incentive compatible contract. Why is it incentive compatible? Because N has no incentive to settle for less than H. And the contract is minimal. That is, the non-monetary punishment is always exactly as much as the difference between the agreed payment and the actual payment Z of Y. Why? Due to this max argument, the punishment will always depend on the greater value of either H minus Z of Y or 0. If N pays back H, both values will be 0 and the punishment will be 0. Full repayment, no penalty. If the company pays back more than H, he won't be punished, but will neither get any negative punishment reward, because then he will just get a 0 punishment. Yeah? This is also clear. If you will not get a reward for repaying your loan. You will only get a punishment if you default on your loan. And if the punishment would be less, then N wouldn't have any incentive to pay back anything. So it's incentive compatible. We see that the only party that requires an incentive is the company, because the company has more information and it has leverage over investors. And this penalty function is incentive compatible because we have no incentive to settle for less than H, and we have no incentive to default on our loan. Because if we default by 10 cents, we will get 10 cents in terms of non-monetary punishment. In other words, if you default on 1,000 euros loan, you will get a slight and small punishment. But if you default on a $1 billion loan, you will get probably a jail term. And the punishment will be higher, the higher the amount is you default on. What is the amount of repayment? Now, N offers a repayment which makes L choose the investment project over the risk-free investment. And to maximize his or her own earnings, the repayment will make the lenders indifferent between choosing between both alternatives. So the expected repayment, the expectation of Z of Y is R. Again, we have to keep in mind that we will not, if we take $1 as a loan, we will not promise 2 euros or 20 euros as a repayment, but still the company wants to make a profit. So it will choose the lowest amount of repayment so that the lenders, the investors, are indifferent between investing into the company or simply taking the risk-free asset. Then, of course, the expected repayment has to be R. Then the investment will be just as favorable as the risk-free asset, and the investors will be indifferent. So Z of Y is the minimum of H and Y, and this is the aggregate repayment to all lenders. If the project earnings are Y less than H, N has to give everything to the lenders. If the project exceeds the repayment, N only repays H. Quite clear, as in any natural, that is why it's called a natural debt contract, because this is simply a theoretical description of what a regular bank loan looks like. Yeah? We need to offer a higher rate of return than the risk-free rate of return. We need to guarantee repayment, and there has to be some clause in place that you cannot simply default on your loan without consequence. Thus, it follows if we take the probability that we default on our loan times the expected return in case we default, plus the probability that we do not default, that project earnings are higher than agreed repayment, times the agreed repayment, this has to be R, and this has to equal the expected repayment expectation of Z of Y. And then the expected value of Z includes the partial repayment with probability P of Y less than H, and the conditional expectation here, or full repayment with probability that earnings are higher than the agreed repayment. Also very natural. Default, non-default. In the case of default, we cannot repay full H. In the case of no default, if earnings are higher than H, we will only repay the agreed amount of money, H. In this case, H minus R is the risk premium. And in case of poor project earnings, N is punished without any benefits. And because all lenders are risk neutral, they only consider the expected value of the project earnings and not the probability distribution. This makes it easier in the model. We do not care whether it's 50-50, 30-70%. We only need to look at the expected returns here, the expected repaid amount of money, expectation of Z of Y. And independent of the probability of the investment success, the expected repayment is always R. Okay. Now, what are the costs? Because remember, best case scenario, symmetric information. If both parties can observe all payments, no party has an incentive or the possibility to defraud the other party, and we would have no costs at all. So what are the costs of this penalty function? The first best solution under symmetric information is simply expected return is R, and the profit for the company is the expected return minus R. Second best solution, due to the ex post information asymmetry of the lenders who cannot observe the outcome of the project, that is the debt contract with penalty function phi star and a suitable H, and the profit of the company now is the expected return minus H. It has to repay the loan. It has to repay the agreed repayment H, be it monetary or non-monetary in nature. But if we repay H in cash, we have to pay H. If we only pay 50% of H, we will get an additional penalty to bring it back to H. So this is the second best solution, and you can see the difference between the first best and the second best solution is the cost of asymmetry. By including information asymmetry, the difference between the first and the second best solution now, H minus R, is the costs of asymmetry, of information asymmetry. Now let's continue our numerical example. We have a debt contract with penalty function and a repayment of H over M equal to 0.13. The expected value of the claimed repayment H equals the return of the risk-free investment, that is 0.11. The aggregate repayment to all lenders is H equal to 1.3 in case of project success, or failure, then Y2 is 0.88 plus a non-monetary penalty, exactly as the difference between H and Y. In this case, 0.5, claimed repayment minus remaining debt. And due to the penalty, N's expected profit is negative despite the surplus if the project succeeds. So in this case, we would have an expected profit of minus 0.08, meaning that with a risk-neutral entrepreneur that has a project with a negative expected return, the project will not be done. So the project is not carried out because the contract costs here exceed the project surplus. So even with this contract, no project. Now, why could monitoring be advantageous? Penalties reduce welfare, because obviously the first best solution works without monitoring and without penalties. Therefore, it could be advantageous for N to allow all lenders to observe the project earnings. Now remember, this is how shall I put it? Do you see what happens in this case of a debt contract, of a normal debt contract with a penalty function? You might have missed this. Where's the bank? No bank. We haven't included a bank yet. And here in the numerical example, you can see that although this is an optimal contract with an optimal incentive compatible penalty function, it could still be that no project comes out of it, because the costs of including this penalty are so prohibitively high for those lenders that they are not willing to directly invest into this company. And we will now see that by including a bank, we will somewhere arrive between those scenarios. We will not achieve the first best solution of information symmetry, but we will get to a better case in which we can reduce those information costs. Now, monitoring could be advantages. Information asymmetries are eliminated. N must pay monitoring cost K to every lender. We have costs of monitoring A, M times K, and a repayment of now the expected return. Because remember that if you eliminate information asymmetries, we do not need to look at Z of Y, but we can observe Y. So the repayment obviously should be the expected value of Y. The choice of the contract type depends now on the respective contract costs. We have welfare decreasing penalty costs, H minus R, versus monitoring costs, M times K. And we see that we can get to a situation where we have information symmetry, but only if we are willing to invest M times K, the monitoring costs. This is how we can come to the first best solution, or at least to a case that is close to the first best solution. In this numerical example, we have assumed costs of monitoring of, say, 0.03. We have contract costs that are 10 times 0.03, meaning we have a total contract cost of 0.3. And in this example, the monitoring costs are even higher than the costs of the debt contract, meaning, again, we still don't have a bank. We simply the company allows all lenders, all investors to monitor, for example, the number of sold pizzas. But each and every one of you as investors would have these costs of 0.03, and in total, because I need to disclose this information as an investor to all of you, I have prohibitively high monitoring costs. And this is where we include our bank, where we include a financial intermediary. And it has become famously known as delegated monitoring, because monitoring is now delegated from the company to the bank, and the bank acts as a delegated monitor. We can save monitoring costs by delegation. The financial intermediary takes over monitoring, and it only needs monitoring costs of 1 times K. It doesn't need to repeat the monitoring as every lender would have to do, but it can do monitoring for the lenders once and for all. It only has 1 times K monitoring costs instead of M times K. The problem, we now have information asymmetry between the financial intermediaries and the lenders. Remember the case that I told you we cannot simply explain the existence of a bank by arguing that the banks can save on transaction costs. Yes, they can save on transaction costs, but the problem is that now we have information asymmetry between the bank and the lenders and the investors. We still don't have a reason why we should trust the bank instead of the company. So we have delegation costs, the necessary costs to solve the cooperation problem between the financial intermediary and the lenders, the investors. To justify now the usefulness of a financial intermediary, one has to show that despite the additional delegation costs, total costs decrease. So we have monitoring costs to improve on the optimal debt contract, and we have delegation costs to save on those monitoring costs and to arrive at a situation where we have an optimal contract for all sides and all parties. The financial intermediary is also risk neutral. It doesn't have own capital, so it can only take in deposits from investors and give out the loan to the company. The financial intermediary receives the payments from the lenders. It finances the projects of the entrepreneurs, gets a repayment from the entrepreneurs, and then transfers money to the lenders. It repays the loans. Here you can see it in a plot in German. Have a look at it in the textbook and try to read the original paper. Now, the total costs of a financial intermediary are the contract costs of N and the delegation costs of L. The financial intermediary creates information symmetry. If a direct investment by N, by the lender, it is now replaced by investing into the project of the bank, and we have the same success probabilities and the same share of earnings, of course. And we can reduce the delegation costs by diversifying. So the financial intermediary finances projects of several companies and invests funds from now M times N lenders in N projects. Every lender agrees on a debt contract with a penalty function with the financial intermediary. Because remember that, of course, the information asymmetry between the company and the lender is not simply replaced by information symmetry. We still need an optimal debt contract between the bank and the company now, because the bank needs to force the company to stick to the contract. And the total amount of repayment depends on the outcome earnings of all projects. So, through diversification, the probability of a negative outcome of the whole project is lower because the project earnings are independent, and the repayment amount H the lenders are willing to accept, and the welfare loss decreases. And this is a cost reduction by the financial intermediary. So we have monitoring, delegation costs, we have diversification because the bank can now invest into many projects, and we can have a look at this numerical example. The bank uses funds from, say, 30 lenders to finance 3 projects. All projects have an income allocation of, again, 1.5 or 0.6, 1.5 or 0.8 with 60 and 40% probability. All the projects are independent. The financial intermediary monitors the companies and receives monitoring costs from every company of $0.03. We have an agreed repayment with every company of $1.4507 in case of success, and repayment of the whole project earning of $0.77 in case of failure. You can later on see how you can come up with these numbers. The independence of the projects leads to the following total return of all projects. You simply have to multiply the probabilities, and you can get different scenarios. 3 projects, that's quite clear. All 3 fail, one fails, two fails, all three are a success. And you can, because of independence and the given probabilities, you can calculate the probabilities. Then you can calculate these, multiply them with the probabilities, and this is how you can get the agreed repayments. Every lender receives 1/30 of the returns. Because of diversification, an investment in these projects has a lower risk of default than a direct contract with a company. And only with a probability of 35.2% will a lender incur a loss, whereas with a probability of 1 minus 35.2%, every lender will receive the full repayment of HL. For an agreed repayment of only HL, of H over M, of $0.11784, every lender is willing to lend $0.1 to the financial intermediary. And the expected return is exactly equal to the return in the risk-free investment, 10%, and so on. And you can see that in a direct lender and company relation, the repayment was $0.13, and we have a positive effect of diversification. And this is now the final result. We need to compare financing with and without a financial intermediary. We have direct financing without financial intermediary. We have costs per company of the minimum of M times K, or the expected return of the penalty function of Z of Y. That is what? If we want a direct relation, we either need to use an optimal debt contract, or we need to monitor, have to pay monitoring costs. That is the case where either we have an optimal contract, an optimal debt contract, I have an incentive, I'm the owner of my pizza restaurant, and I will get punished if I don't repay my loan. Or if there are no punishments, I have to pay out monitoring costs in the form that I'm informing all my investors of my current revenues. I'm telling all my investors, today I've sold 75 pizzas. And because I have to inform each and every one of you, in a direct lender-entrepreneur relationship, I have monitoring costs. So the minimum of M times K, M times the monitoring costs, or the costs of the optimal debt contract, that is these are the minimal costs of the direct lender-company relationship. With the financial intermediary, we have a contract with monitoring between the financial intermediary and each N. But why are the monitoring costs lower here? Let's make it more realistic. The pizza restaurant has to send the annual statement and annual balance sheet to all investors. I have to print my balance sheet and my income statement, and I have to send this information to all my investors. Why is the monitoring cost? Why are monitoring costs lower with a financial intermediary than in the direct lender-company relationship?
Because the entrepreneur only has to send the monitoring information to the financial intermediary.
Yeah, I only have to send the information on my balance sheet once to one bank instead of sending this information to 20 investors. So monitoring costs for the company, they are lower. And each between the financial intermediary and the company, and we then have debt contracts between the financial intermediary, the bank, and the lenders, the investors. Every company's costs are now K plus D, the delegation costs, and delegation costs, those are the risk premium for the contract between the financial intermediary and the contract. Let's be clear. This is the delegation costs. They are, the risk premium for the contract between the financial intermediary and the entrepreneurs. Okay. Now, financial intermediation. has an advantage over the direct relationship between the companies and the lenders if, obviously, those costs are lower than those costs. Situation with financial intermediary, better than the case without. K plus D, lower than the minimum of the monitoring costs or the costs of the optimal debt contract with penalty function. With increasing N, the delegation costs are decreasing as the financial intermediary is effectively able to offer risk-free debt contracts because of diversification. So the advantageousness or the advantage of a well-diversified financial intermediary then becomes K, because delegation costs are close to zero, K lower than the minimum of M times K or the optimal debt contract. And obviously, because this here is trivial, K is always smaller than M times K, this is equivalent to K less than the expected penalty and the expected penalty depending on Z of Y. Therefore, a direct financial relationship between N and S and the lenders is only beneficial if the monitoring costs are high or if default risk is zero. Obviously, if default risk is zero, we are not faced with a situation where the company can exploit asymmetric information. Then, of course, any type of delegation or monitoring costs are superfluous. But here, if K is high, then of course also we would opt for a direct relationship. But if K is the individual K, for example, sending out a balance sheet, if the individual monitoring costs for one investor, if these are quite small, then here a well-diversified bank has an advantage over a direct financing relationship between the company and the lenders. Yeah? And this, more or less, is the diamond model. It first of all shows what problems you have without a bank. That is, if you don't have any rules in place and you have information asymmetry, the company can defraud you. It can simply tell you, oh, sorry, I don't have any money, I default on my loan, and you have no way of recovering your loan. Now, if you know this, you will never enter such a contract. You will never give out a loan. Then the company will have no funds. So in order for the company to get funds, to get financing, it needs to offer an incentive-compatible contract. And this can be done, for example, by including a penalty function. This is the optimal, the normal debt contract. But still, this would mean that we have a case where we would get financing, but everyone could be better off by including a bank. And this is the case if inclusion of a bank reduces costs compared to the case of the normal debt contract or individual monitoring costs that sum up and at some points, as in the numerical example, are prohibitively high. If I have to inform 50,000 investors with elaborate information on my project outcomes, this cost will be prohibitively high and I will not be able to make a profit. And if the company doesn't make a profit, it will never start the project in the first place. So banks can reduce monitoring costs and it will be able to reduce delegation costs to zero by diversification. And this is the basic theoretical explanation why banks exist, or more generally why financial intermediaries exist, because you can explain you can generalize it to other types of financial companies as well. Okay. Do you have any questions? You might want to have a look at this diamond model, because this is a very good thing to ask in an exam. Explain the basics and the different types of situations in the diamond model. explain what a normal debt contract is, explain why banks exist. Yeah? And I mean, if you go through this model 2 or 3 times and take an hour and just go through all the different steps, I think it's quite clear to see what is the first best solution, what is the direct financing link, what is the case of a financial intermediary, and what delegation and monitoring costs are. Yeah? Okay. If you have no further questions, thank you for your attention and see you, I would say, next week. Yeah, we don't have any holiday next week. Oh, thank you.